We've had a very tough start to 2022 as investors in the stock market. My portfolio is down year to date, as you can imagine, and I'd bet that almost all of yours are as well. The heat has really started to pick up these past 2 weeks, though, with the Nasdaq down almost 10% in that time and the S&P even down 6%. The Nasdaq is down around 16% year to date and the S&P 500 down 10% year to date as well. And we've seen some crazy drops in some previously beloved stocks such as Netflix, who guided for slower than expected subscriber growth this year, leading to the stock price losing around 25% of its value. Now, we've continued to see weakness in the growth-oriented space, with companies who did extremely well in the pandemic shedding up to 50% of their value in some cases. And although these are big drops, some people are saying that it's just the start and that we're going to see the market go into a potential freefall from where it is today. Jeremy Grantham, for one, thinks the S&P could fall 50% from where we are today. And whilst I don't have a crystal ball and don't tend to spend much of my time trying to predict what the stock market is going to do in the shorter term or guess the future macroeconomic conditions, I do, however, think we should look at what's causing all of this turbulence. And a lot of it is this man here, Jerome Powell, chairman of the Fed. Essentially, he has the stock market and most of its participants on puppet strings in the short term. That is because he is responsible for setting the federal funds rate, which dictates interest rates in the US and subsequently has a knock-on effect around most of the world. But focusing mainly on the US for now, what drives the Fed's decisions on interest rates is economic conditions. But in this specific case, the variable that's being focused on the most is inflation. And inflation is here. Non-transitory inflation seems like it's here, and the inflation rate is speeding up month on month to levels not seen for over 25 years. And inflation is all around us, not just for consumer goods and utility prices, but look at the stock market. Prices soared after one of the biggest economic downturns we've seen in decades. The price to earnings ratio of the market has reached historic highs. House prices are at all-time highs too. So there's asset inflation, there's consumer utility price inflation. It is everywhere. Now, inflation has come with no surprise to Jerome Powell and other central bankers. However, what was coined as transitory inflation, i.e. not here to stay, by Jerome Powell off the back of reopening and economic recovery, is now seeming as though it will be persistent for a while longer, unless things being monetary policy, change. And so in his latest press conference, Powell repeatedly dodged questions about his thinking and position now that inflation seems to not be transitory. In fact, he refused to rule out aggressive rate hikes in the near future to help control US prices and inflation. And a lot of the market saw this as, a signal to strap in and be prepared for a bumpy ride. A lot of people even seem to have just sold out of their positions altogether, something that I definitely wouldn't recommend. But the translation here to stocks is quite obvious. Interest rates, as Warren Buffett says, are like gravity for stocks due to their discounted present value being adversely affected when interest rates are higher. You're discounting back at a higher rate in most cases if that's what you do. And higher interest rates have an adverse effect on consumer and business spending. So there's both a theoretical and economical point of view that makes interest rates a bad thing for stocks. Inflation is obviously terrible as well for things like consumer demand due to rising prices, and very bad for businesses with little to no pricing power, but continued capital requirements and need for raw materials to run their businesses. That can run some businesses into a really bad situation and kill profits. So what that means is that almost all companies and stocks are affected, and there's very little ways around it in the short term. And I will admit the stock market is expensive overall, and there are pockets of the market that are overly speculative and maybe even in bubble territory. So the Nasdaq and S&P coming down, 15% this year, isn't that surprising. But I'm not going to get into the potential for markets to crash even further from here or how likely that is. I think personally it would be unproductive to spend time doing that. But let's just keep it in our minds as a real possibility and assume that it may well happen. And in fact, it might be likely that it happens. And instead, I want to spend more time talking about how an investor with an ambition of outperforming the market in the medium to long term can be prepared for a market crash, focus on what really matters, stay rational, and then even thrive and profit in an environment like this. And we're going to look at real life examples of this today. So the first thing to just point out is that, of course, there are many ways to make money in markets. Many great investors in the past have some shorter term trading strategies, not necessarily investing strategies, but trading strategies that can actually do very well in these conditions and have made great returns. But here we're talking to a retail investor audience, I'm guessing, or mostly, and we're talking about a retail investor who could employ a longer term strategy and use time arbitrage to outperform the market. So let's take Netflix as an example. Netflix has been the victim of the widespread change in market sentiment, both from reporting weaker than expected near-term results, which, by the way, wasn't something many investors without a crystal ball could have foreseen, so there is that. But there has definitely been a knock-on effect by the bad market sentiment or just the general market sell-off and growth stocks falling out of favour. And this has led to the stock declining around 36% in the past 28 days, even with its small recovery in yesterday's session. Now, Netflix, of course, is one of the greatest performers of the past decade, and with any luck you bought back in, say, early 2012 and made around 36 times your money in the past 10 years. But what do you do if you're someone who bought, let's say, 2 years ago in the pandemic, thinking that Netflix was going to be a big beneficiary, or even worse, you bought back here around a month or two ago after this perceived dip, thinking that the stock price had dipped and had dropped somewhat, so it must be undervalued, meaning for every $100 you invested, you now only have $60 after just 1 month. That's very hard for most people to stomach, and even harder for people to stomach if they don't have true conviction on the value of the business that they own and don't know that the market is being irrational. Because now the story the market is telling with Netflix has suddenly changed overnight. It's gone from best-in-class, highly investable, recurring revenues and still a good runway for growth to now being overvalued, unprofitable, highly competitive and slowing growth. That is the perception that's changed just with these quarterly earnings and a near-term guidance, near-term being the key word. They've been the big factor in that, but this demonstrates the market's ability to be irrational. You have to ask yourself, how can both of these perceptions of Netflix be true within the same 30-day period? And that's because they can't. Now, the truth probably lies somewhere in the middle for Netflix. This isn't going to be an analysis on Netflix today. We are just using it as an example, and I don't actually have a firm opinion or position in Netflix for disclosure. But this really proves the point that you need to have a firm opinion on the stock that you own and therefore the company's intrinsic valuation. That means researching the business and its market, assessing its strengths and weaknesses, opportunities and threats, and looking at all the variables that dictate the business's success and results and what are the likely outcomes, and then having a way to try and deliver that as a measurable financial output. And for me, that output usually is, as you'll see on this channel, and that's what we go through when we analyze businesses, simple to understand DCF model analysis. But for some people, it may be another way of looking at it, and that's fine. But you need to have that opinion on the firm's valuation. You can't not have it. Personally, I think this period in time really shows the limitations of traditional optic valuation metrics. Looking at Netflix and saying it's undervalued because it trades at 32 times EBIT and it ordinarily trades at 50 times, or the market is trading at 30 times, and this is a better company than the average, etc. So, why wouldn't you just buy it? You'll probably do well from buying it. That just wouldn't be enough. And now it would have made you highly skeptical of your decision and maybe even forced you into a sell mindset at a big loss, which is not what you want. So the advice here is know the estimated intrinsic value of the business that you're buying or have bought. Also know that it's estimated, meaning that you can be wrong and that value can move, but only with good reason, not because of stock price volatility. That is another research process that you would have to go through if you think there's good reason for it. And of course, the story can change, and even things like interest rates and inflation, like I said at the start, have real effects on businesses and therefore the valuations of stocks. But that is what should go into your research for a business in the first place. Now, the other side to this, which is really the main part of the video, is You can really profit from bad sentiment if you do the qualitative research required and know your valuations. One real life example of this, sticking with Netflix, is Bill Ackman's Pershing Square, buying very recently 3.1 million shares in Netflix just after the sell-off brought the stock price down to below their estimate of intrinsic valuation, making it a $1 billion position in his fund. Now, in his letter to shareholders, he outlines his thesis. He says the opportunity to acquire Netflix at an attractive valuation emerged when investors reacted negatively to the recent quarter's subscriber growth and management's short-term guidance. Netflix's substantial stock price decline was then further exacerbated by recent market volatility. We have greatly admired Netflix both as consumers and as investors, but have never owned a stake. Netflix's qualities include a subscription-based, highly recurring revenue model, which has enormous future growth potential, best-in-class management team and unique high-performance culture, economies of scale and industry-leading content being its competitive moat, pricing power based on enormous value to consumers, substantial margin expansion opportunity, and improving free cash flow profile, which should allow for continued reinvestments for growth or return of cash to shareholders. Now, like I said, this isn't an analysis on Netflix, but Ackman has just shown us what it means to be a prudent or good rational investor in these times. He's taken a contrarian view on a stock and plans to use time arbitrage to his advantage. He's also looked at the qualities of the business that he's planning to own and concluded that this company will actually do just fine in a higher inflationary or higher interest rate environment, mainly due to its pricing power and highly sticky revenue base. Sure, the Netflix bet hasn't played out yet, so we don't know if he's right or wrong, but he's made these moves before and profited handsomely. So before we get into my concluding thoughts here, I want to just read the last part of Ackman's letter. While we don't know what the stock market will do tomorrow, next month, or even over the next year or two, we believe our companies will continue to compound their intrinsic values at high rates for the long term. We're pleased to add Netflix to our portfolio, and many of our best investments have emerged when other investors whose time horizons are short-term discard great companies at prices that look extraordinarily attractive when one has a long-term horizon. And this sums up exactly how a long-term, fundamentals-driven investor should be thinking. Markets are irrational and unpredictable in the short term, but they're driven by fundamentals in the long term. Fundamentals can be analysed and predicted a lot easier than market sentiment, even if you have a lot of information, macro information available to you. In many cases, you can even know what will happen with the economy and not be right about what will happen in markets. COVID back in 2020 taught us that if anyone knew what was going to happen with COVID in 2020 back in 2019, they probably would have shorted the market or sold out of all of their positions. And inevitably, in the long term, that would have been the wrong thing to do because the market more than doubled from its low in 2020. So that's just something to think about. And my concluding thoughts here and three takeaways for staying rational and even potentially profiting in this market, what I would be doing is know and have a firm opinion on the intrinsic value of the companies you own. This will allow you to deal with volatility a whole lot better. Second is ensure that intrinsic value is based on good fundamental research and analysis. You have to really put in the work to have conviction on a company. It is as simple as that. And third is more geared toward opportunity, and that is keeping a watch list of stocks that you've done research on already, knowing their intrinsic value also, and this will help you to spot big opportunities when they arise due to short-termism in the markets. This is exactly what Ackman has done here with Netflix and that purchase, and with the likes of, say, Domino's Pizza and Chipotle before. I've done this on occasions, and a lot of the time, you'd be surprised if you look back after 5 years and see how many companies actually come down to the price that you're really willing to pay for them. A lot of them won't, a lot of the best companies won't, but a lot of the time they do. Stocks tend to go through these meltdowns every couple of years. And if your thesis is right, your payoff will be handsome. And hopefully, if you've done good valuation work, even if your thesis is slightly wrong, you won't do too badly either. And the fourth that I'm going to add in, just a bonus one, and it's kind of related to what we've looked at today, is look at what the best investors are doing as well in times like this. When the market's melting down, a lot of the best investors are actually putting their money to work in businesses that they've done deep research on. So you can leverage that to sort of filter out ideas, and it's something that I like to do as well when the market seems to be irrational is looking at my short list of best investors that I like to follow and seeing how they're behaving and potentially what companies they're actually diving into. But that's going to be all for this video, guys. Hopefully you enjoyed listening to my thoughts on the current market and how we can position ourselves to potentially benefit from this volatility and on the defensive side, stay rational and focus on what matters. So just before we end, I just want to remind you that if you're interested in getting additional exclusive content and analysis, as well as getting access to our investing community Discord, you can do so by checking out the Patreon. I'll leave a link below. I've actually just posted a 6,500 word deep dive write-up on Mercado Libre, which is the stock we're going to be doing in January, and analysing for an investment opportunity. And we'll be doing some others each month going forward from here, plus all of the other analysis I do on there. So check that out if you're interested. It's a small monthly subscription, but it supports the channel and all the content that I put out. But additionally to that, if you want access to Ticker, which is the stock analysis research platform that I use on a daily basis that shows you all of the valuation metrics, financials going back. You can track investing gurus and things like that. You can do so by going to ticker/finding alpha. You can get a significant lifetime discount if you join today. So go and check that out. But apart from that, please leave a like on the video, comment your thoughts down below, and if you'd like me to actually dive deeper into Netflix off the back of this Bill Ackman buy, I can do that as well, so let me know. And obviously, subscribe to the channel if you haven't already. I will see you all in the next one. Good luck with all of your investments.